Okay, so we are going to pick back up with chapter 10 today. Today is the last lecture, so we will finish chapter 10. We don't have much left. So I gave these out last time. Did anyone not get one? Surely everybody did. I think everyone was here. Okay, so make sure you bring this with you into the exam. I mean, in my opinion, it's very helpful, but I'm the one that made it, so I'm biased. It goes the way my mind works, which is not necessarily the same as everybody else's. So, all right. So last time we left off. Hold on one second. I've been having some problems with the video loading recently. Okay. So last time we left off with question 4. So question 4 was, what type of organization are you contributing to? And there are really two possibilities, right? If it is a valid, nonprofit, charity, that kind of thing, there are two possibilities. The first one being a 50% organization, and the second one being a private, non-operating foundation. These are the two different possibilities. So if you fall under this 50%, or this would be things like your churches, your schools, hospitals, government type organizations, things like that. Your typical things that you think of when you think of a nonprofit organization. A private non-operating foundation is basically a foundation that is not using the funds that they receive to operate their tax-exempt purpose. So how do you know if something is non-operating? Again, you just have to call them and ask. And it changes every year. So these are the two different possibilities. And if you take a look at the sheet I gave you, it says on the front page, who are you contributing to? So that's first question I have on my page. So question number 5, which is, what are you contributing? Slash, what is the value of your contribution? So these type of questions kind of go hand in hand, which is why I put it as the same question. Now, once we get to question 5, if you will remember, last time we talked about questions 1 through 3. The first question being, is it a gift, period? So once we get to question 5, we are assuming that it qualifies as a gift under the charitable contribution code section. So it's not that you're not donating blood in a blood bank, which remember, that's not considered to be a gift under this charitable contribution deduction. It's not services. So once we get to this point, we are assuming that what you are contributing qualifies. Okay, we've already gone through the other questions of, is it the right time to deduct? Is it considered to be a gift, period? We've already addressed that. So now we're at this point. What are you contributing slash what is the value of your contribution? And two real possibilities. We have ordinary income property. And I'm going to find this on the slides, because I know some of you would rather look at the slides. Slide 53, ordinary income property. So the kind of things that are ordinary income property. First and foremost, this would be like cash, which technically, is that really ordinary income property? I mean, you don't sell cash, right? I mean, you sell, it doesn't work like that. So, but cash is considered to be ordinary income property. This would basically be anything that produces ordinary income when you sell it. So something that has not been purchased for investment purposes, something like that. This would also include short-term capital gain. So if you have held stocks for less than or equal to 12 months, then it's going to be short-term capital gain, and this is considered to be ordinary income property. If you have ordinary income property that is contributed, your deduction amount equals the donor's basis, unless the basis is greater than fair market value, so it's a lost property, then it's going to be the fair market value. The next possibility is capital gain. Or 1231 property. We haven't really talked about Code Section 1231 much in this class, but 1231 property, long story short, is really property that has been purchased for a business and has been depreciated on. So something like equipment, that would be 1231 property. A rental property that you have, you sell it, that would also be 1231 property. So these are the two categories here. All right. Generally speaking, the deduction amount is the fair market value. But there are two exceptions. Unless the property is contributed to a private, non-operating foundation or if the property is tangible personal property and it is put to an unrelated use. By the organization. So let's talk about this. So we've already talked about this exception, right? What's a private non-operating foundation? We've already talked about that. But let's talk about this one. And if it qualifies for either one of these, then the deduction is basis, not fair market value. So if it qualifies for either one, for this right here, we have to look at two things. First of all, is it tangible personal property? So let's think about the words personal property first. And this is on slide 56. Personal property is basically something that's not real property. So not land, not buildings. Tangible, meaning it's not intangible. Things that are considered to be intangible, stocks, bonds, copyrights. I don't know why you donate a copyright anyway, but something like that. All those are considered to be intangible. So, and the second component to this, it has to be put to an unrelated use. So if it is put to an unrelated use by the organization, so a use that is not associated with their exempt purpose. So there's an example in the book, okay? It's example 30. Emma contributes a Picasso painting for which she paid $20,000. So she paid $20,000. So that's her basis, right? It is worth $30,000. She contributes it to a museum, which is a 50% organization, and the art museum puts it on display. 5 years later, they sell it. So she wants to know, how much is her contribution going to be here? Is it going to be the basis, or is it going to be the $30,000 fair market value? Sorry. Okay? So let's take a look at these exceptions. Was it contributed to a private non-operating foundation? No, it was contributed to an art museum, okay, which is a 50% organization. Second, is it tangible personal property, the painting? Yes. Yes, tangible personal property. It's personal property, it's not real estate. A painting is tangible. You can touch it. You probably shouldn't touch a Picasso painting, but you can. Yes, tangible personal property. Is it put to an unrelated use? What do you think? No. She gave it to an art museum, and the art museum is using it in their collection. That's not an unrelated use. So, no. That means that she is going to be able to use the fair market value as the value of her contribution, not the basis. Because this is a capital gain problem. And one of the exceptions doesn't apply. So, now what if instead of contributing this Picasso painting to an art museum, she is contributing it to her church? What about now? Is that a related use? No. It's not going to be a related use. Okay, what about instead of contributing a Picasso painting, she contributes a crucifix to her church? Would that be a related use? Let's assume it's a Christian church. Probably. Yeah, probably, right? So it is a little bit fuzzy, right? A little bit subjective. But generally, I think you can get to a rational conclusion on what is and is not an unrelated use. Okay. And the last question to consider. I don't know why Congress decided to make multiple limits, but they did. Hold on, I'm going to make sure you can see this from the camera. No, you can't. Okay, let me move that. Okay. So the last question here is there a limit to their charitable contribution? I'll just say CC, so I'm not writing it out again. Is there a limit to their charitable contribution? Now, remember, charitable contributions are an itemized deduction on Schedule A. We have talked about two other types of limits that apply with itemized deductions. One yet last week, or Monday, we talked about medical expenses. Remember, we said medical expenses, to be able to deduct it, it has to be in excess of 10% of adjusted gross income. We said the same thing about miscellaneous itemized deductions. We said it has to be in excess of 2% of AGI. Please remember these limits on charitable contribution, and there are 3 of them. The first one being 50% of AGI. Then 30, then 20. We're going to talk about 50 first. These do not work the same way. They actually work the opposite. Instead of saying you only get to take a deduction for what is in excess of 50% of your AGI, we say you only get to take a deduction for what is less than 50% of your AGI. So this is a ceiling, not a floor, like the 10% of medical expenses, like the 2% of itemized deductions. Charitable contributions works differently. So don't get confused on how those are calculated. This is a ceiling. All right. So the first option is a 50% ceiling. This applies if property is contributed to a 50% organization. So remember, at this point, we have already answered question 4. What type of organization is it contributed to? So we have to know that to be able to answer question 6. The property contributed is to a 50% organization, and, okay, it is not appreciated capital gain property. So to be able to know if you are in the 50% ceiling, you have to have answered question 4, and you have to have answered question 5. Because we have to know, are we contributing capital gain property? If so, is it appreciated? What does appreciated mean?
It's increased in value.
That's right. The basis is less than the fair market value. Okay? So this is your first ceiling, 50%. I'm going to erase this. Second ceiling, the 30% of AGI ceiling. This applies in really 2 circumstances. One, it is contributed to a 50% organization, and it is appreciated capital gain property. So what does that mean? If you fall out of the 50% right here, okay, because you're contributing appreciated capital gain property, then you're going to automatically be in the 30% ceiling. Or, there's 2 ways you could fall into the 30% ceiling. The second way is if you are contributing non-appreciated capital gain property to a private non-operating foundation. These are the 2 different ways you could fall under this 30% limit. Okay? And the last limit, which is the 20% of AGI ceiling. Can you guess which category of property is going to fall into this one? What do you think? It's right. If it is non-appreciated capital gain property contributed to a private non-operating foundation. So 20% only covers one situation. Basically this one. It is a contribution of appreciated capital gain property to a private non-operating foundation. There are a couple operating rules here. Let's talk about the operating rules. First one is important to remember. One taxpayer is probably going to contribute multiple different types of property during the year. So you could potentially have a taxpayer contributing something from this category and something from this category. So how do you know how to calculate your limits? Well, the first operating rule to remember is after all of your limit calculations, the taxpayer's charitable contribution deduction can't exceed 50% of AGI. So and honestly, it should be that way anyway, okay? But it's kind of a way to check yourself. You can, at the end of the day, have some contributions from a 50%, some from a 30, some from a 20, and all those added up should not ever exceed 50% of AGI. So that's the first operating rule. The second one is more of like a cheat sheet for you, a way to get around calculating limits. So if the total charitable contribution is less than 20% of AGI, it's really less than or equal to, honestly. Less than or equal to 20% of AGI. No need to do a limit calc. Why is that? Well, the lowest limit is 20% of AGI. So if all of your contributions during the year are less than 20% of AGI, why do you even need to worry about the limits? There's not going to be a limit. So, and that's kind of a shortcut way, especially if you're talking about this exam or the CPA exam. Don't spend time that you don't have calculating limits when you don't need to. If you have a taxpayer that has $100,000 of AGI and is contributing $15,000 worth of cash and property, you don't need to go through the limits, right? Because the lowest one is 20%. It's not going to impact the amount that you are able to take a deduction. Because the maximum amount that that taxpayer can deduct with an AGI of $100,000 is $20,000. And they're only contributing $15,000. So not an issue, okay? Lastly, if you have any excess charitable contribution, it can be carried forward for 5 years. But it keeps its classification. So if you have 30% property that you are not able to use in 1 year, it will carry forward as 30% property in the next year. We'll see an example here in a minute. Okay, probably ran out of room on my computer screen there, but okay. So all these, this is on the slide too. Forward, this is on slide 62. Okay, so let's talk about a couple examples here. I'm going to okay. So let's talk about some simple examples here. Let's say you have a taxpayer with $100,000 of AGI. And this year, they are contributing, $40,000 in cash to their church. They're very nice people, very generous. So how much is going to be their deduction for charitable contribution? Are we going to be in the 50%, the 30%, or the 20%? So first question, are they contributing to a 50% organization? Yes. What type of property are they contributing? Ordinary or capital gain? Ordinary, okay. So which bucket are they going to be in? $50%. That's right. So does that mean they're going to get to take their entire $40,000 as a deduction? Yes, because it is under $50,000. Let's see. What if, these aren't examples in the book, so I'm kind of making them up as they go along. Okay, so what if this taxpayer, instead of contributing cash to their church, is going to contribute land, okay? And it has a basis of $40,000 and a fair market value of $60,000. So now, which category, first of all, I guess the first question is a church 50% organization? Yes, already answered that. Second question, what is going to be the value of their contribution? Is it going to be the basis or is it going to be the fair market value? Yes, you're right, fair market value. Why?
Because it's ordinary property to a 50%.
It's actually capital gain.
Sorry, so capital gain to a 50%, not a,
That's right.
it's not a non.
And it's not personal property, so we don't even need to get into the question of is it put to an unrelated use, not relevant. Why? Because it's not personal property. It's real property. So that's second question, fair market value. Okay? So now let's figure out which limit we're going to be put into. Is it going to be the 50% limit? No, why?
It's capital gain.
Because it is appreciated capital gain property. Okay, what about the 30%? Yes, we're going to fall into the 30% because it is contributed to a 50% org and it is appreciated capital gain property. So how much of a deduction is this taxpayer going to be able to pay? $30,000 current deduction. And how much carryover are they going to have? $30,000. And what bucket is it going to be put into? The 30%. So that means next year, that $30,000 has to be calculated in the 30% ceiling. All right. So now, what if this taxpayer is contributing this property to a private, non-operating foundation? Okay, so we know it falls in not a 50% org, private, not operating. What's going to be the value of their contribution? Is it $40,000 or $60,000? What do y'all think? The basis or the fair market value? Basis, right. Because it is being contributed to a private, non-operating foundation. And if you answer these questions in the order that we did them in class, you will already know the answer once you get to this point. So $40,000 is going to be the amount of the contribution. Now we need to figure out what bucket we're going to be in. So what bucket do you think we're going to be in? 50, 30, or 20?
20.
There's no 40 bucket. Oh, 20, okay. 20. So you're right, 20. So why? Because we are contributing appreciated capital gain property to a private non-operating foundation. So how much is their deduction going to be? $20,000. And how much carry forward? $20,000. Right? Okay. Great. So let's see. Let's say that instead of this basis being $40,000, it is actually going to be $15,000. Still contributed to a private non-operating foundation. Now, do we need to worry about any limits? Do we care? No. Because $15,000 is less than 20% of $100,000. We don't care. So the entire amount of their contribution is going, they'll be able to take a deduction for it. Does everyone understand how that works? Definitely a big time saver. And on your 1040 assignment, they had charitable contributions, but if you will remember, you did not have to calculate any limits. Why? Because it was under 20% of their AGI. You didn't know that, but I told you, don't worry about calculating limits. You don't need to know that at this point, but now you do. So this is how this works. All right, now let's do the example in the book. All right, so this is example 31 on page 1025, and you will have a problem pretty much just like this on your exam, except with different numbers. During the year, Lisa makes the following donations to her church. She contributes cash. Actually, I think I'm going to go ahead and delete this right here. Just have it written down. So she is contributing cash of $2,000. And she's contributing land, which she purchased 4 years ago for $22,000 and held it as an investment. So she has land. She purchased for $22,000. It's been held as an investment for 4 years. And the value is $30,000. So that's the fair market value. This is the basis. Her AGI is $60,000. It says that she is contributing it to her church. So, is her church a 50% org? Yes, right? Being contributed to a 50% org. Now, the next question is, well, what category of property or what kind of property is she contributing? She has two kinds here. Cash, which is what kind of property? Ordinary, right? And then she has appreciate, or she has land, which was held for investment, which honestly, land is pretty much always held for investment, usually. So you have land here. Is that going to be capital gain property or ordinary income? Capital gain, right? Long term, because it was held for 4 years. So we have capital gain. Next question, what is the value of her land contribution? Is it going to be the basis or is it going to be the fair market value? Fair market value, why is that? Right? She's contributing it to a 50% org, and it is not tangible personal property. So we're going to be using the fair market value. Okay, now the last question. Let's figure out which category she needs to be in. Remember, we also have 20% here. But since she's not contributing to a private non-operating foundation, we can immediately eliminate the 20%. We're not going to be in the 20%. We're going to be in 50 and or 30. So always start with the 50% first. So we're going to start with cash first. Is $2,000 less than 50% of her AGI? Yep. Yes, because 50% of her AGI is $30,000. Right? 50% times 60K equals 30K. We're looking at 2K. So yes, $2,000 deduction for cash. Now let's figure out how much of a deduction she is going to get for her land. So which bucket is she gonna be in, A or B? I mean, 50 or 30%? 30, right? Because she is contributing appreciated capital gain property to a 50% organization. So we have 30% of $60,000 is $18,000. So that means that she is going to receive a charitable contribution deduction of $18,000 for the land and $2,000 for the cash. So we have 18 plus 2, which equals $20,000 charitable contribution deduction for this year. Now, operating rule. We always need to check, is her total charitable contribution for the year less than 50% of AGI? Yes, which is $30,000. So we're good there. Check, not a problem. We know looking right off the bat that we're definitely going to have to do the limit calc because $32,000 is greater than 20% of $60,000. So we definitely did have to go through the limit calc. Next question, does she have any carryover? Yes, absolutely. How much? $12,000, right? So she has $12,000 carry forward. And remember, it is staying in that 30% bucket. So you guys understand how these problems work? If you do it methodical, you ask the question, who is it contributed to first? Then what are they contributing? Then get into the limits. It's really pretty easy. It just involves multiple steps. Why Congress made it so difficult for individuals, I have no idea. Because for entities, it is very simple. Anyway. Okay. I think that's pretty much it for charitable contributions. Okay, I want to talk about, let me switch to the overhead. And I'm going to move the camera. Again, please remember, you're going to have a problem pretty much exactly like that with different numbers. Okay. So let's take a look at this. Comprehensive example of Schedule A. These taxpayers, Harry and Jean Brown, they do married, filing jointly. These are their transactions in 2015. Prescription medicines, $430. Doctor and dentist bills, $31.20. Medical insurance premium payments, $1,200. Contact lenses of $170. Transportation for medical expenses of $63. So if we were to add this all up, go to the next page. We get $41.93, which is their total medical and dental expense deduction right here. And you can see here, this is their AGI of $40,000. This is 10% of it, which is $4,000. Remember, they only get to take a deduction for the excess, which would be $983. Okay, back over. Now we have our taxes. We have state income tax withheld of $3,900 and real estate taxes of $1,580. So if we go back to our Schedule A, $3,900 for income taxes and $1,580 for real estate, for total taxes of $54.80. Next category, we have interest. Interest paid on qualified mortgages, $23.40. Back here, we have our interest, right here, $23.40 for mortgage interest. Next, we have charitable contributions. We have two types, contributions by check and driving for for charity, which is $119. Then, again, go back over. Gifts by cash or check, $860. Other than cash or check, $119. And then we have our unreimbursed employee expenses of $870. Our tax return prep of $150. Our safe deposit box rental of $170. All these are subject to that 2% limit. So we have $870 for our unreimbursed employee expenses, $150 for tax prep fees, $170 for our safe deposit box, which equals $1190. Remember, we have that 40% AGI times 2%, which is $800. So they are only get to take a deduction for the difference between $1190 and $800, which equals $390. So these taxpayers have total itemized deductions of $10,172. Should they itemize or take the standard deduction? Anyone else? Standard. I like how you always guess, and maybe 50% of the time you're right. But I still like it. It's good. It's a good thing, right? I like it. So, that is right. It is good to contribute. It is a good thing. So, our standard deduction for married filing jointly is $12,600. And their itemized deductions, as we just saw, were about $10,000. So which one do they want to use? The higher, right? $12,600. They don't say that in the problem, but they should. That's kind of duh to me, but. Okay. One thing I do want to mention briefly, mainly because I think I said it incorrectly in the last class, and either that or I wasn't clear, and it doesn't really have anything to do with charitable contributions, but we were talking about interest in the last class, and I talked about mortgage interest, and I said, if you remember, there was one category of rental property where you can't deduct the mortgage interest, and I said it was if it is purely rental or largely rental. And I think I said it wrong, but if it's rental, you can still take a deduction on Schedule E. I know this is not this chapter, but I want to make sure I clarify and don't say anything wrong. So you can still deduct the interest on Schedule E that is related to the rental piece, but for the piece that is not related to rental, you don't get to take that deduction on Schedule A. I don't think I said that very clearly last time, so I just wanted to make sure I go back and pick that up. With the other two categories, which were mostly personal and the hybrid, you would still get to take your deduction on Schedule A for the interest. Okay. I meant to correct you and correct myself, and I didn't. So I want to take a look at this one thing real fast. You're not tested on this, mainly because the problem in the book is really long. But just know that there is a phase out for itemized deductions. It is, you have to have a pretty large AGI to have the phase out, but I have heard a lot of political talk out there on decreasing that limit to something a lot more reasonable. Currently, that limit is $311,000 for married filing jointly, or about $259,000 if you're single. Like I said, I've heard a lot of talk out there about changing that limit. So that might be something that changes very soon. If any of y'all have read Trump's tax proposals, which, by the way, is all that they are proposals, okay? And if I will say so, he did not give much detail. So we'll see what actually ends up happening, if whatever Congress wants to do. Okay, so you can have a phase out of what you're allowed as an itemized deduction if you have a rather large AGI, but not all itemized deductions are subject to phase out. So medical expenses, investment interest expense, casualty losses, and gambling losses are not subject to the limit, but other itemized deductions are. And this is on page 1029 of your book. So if you take a look at the next page of the book, there is a rather long example on how this works. It's not very difficult, but this taxpayer has all these itemized deductions. Now you take their total item, and their AGI is 275 and they're single. So we know there's going to be some form of a phase out for their itemized deductions. So the ones that are subject to the limit are these right here. So their gambling losses, their casualty loss, and their medical expenses are not subject to the limit. Only these are. So we add these up, which is $15,500. And then our limit is you have to reduce it by the smaller of 3% of the excess or 80% of itemized deductions subject to the limit, which is 1550 times 0.8. So the lesser of is going to be 468. So that's what we are going to basically reduce. You can see here 1550 minus 468 equals 1532, plus our deductions, which are not subject to the limit, which gives us total itemized deductions here of 21,000. So if you're curious, you want to take a look at that, I encourage you to, mainly because this is a hot button issue right now in politics. This is something that we will definitely see a change in the near future. So thank you all. This is it for this class. Again, if you haven't done the evaluation, I encourage you to do it. I will not see y'all again because I will not be here for the final, but I'm sure I'll see some of you again in advanced tax or ethics, possibly. Let me go over here.